Japanese Candlestick Charting Techniques by Steve Nison. Hello and welcome. Picture this. We're stepping into a time machine together, zooming past the roaring 20s, sailing beyond the Industrial Revolution, all the way back to 1700s Japan. In the port city of Sakata, waves crashing against wooden docks, there's this guy named Munehisa Homa. Sure, he traded rice for a living, but calling him just a rice merchant? That's like saying Mozart just played piano. Homa was a market wizard. People literally called him the god of the markets, and what he pulled off had never been done before. While everyone else scrambled around buying and selling, Homa, he was watching. Not just the weather patterns, though he did that too. No, he was studying something far more fascinating. The hearts and minds of his fellow traders. He figured out that rice prices weren't just about supply and demand. They danced to the rhythm of two ancient, powerful emotions, fear and greed. So what did he do? He invented a secret code. A visual language that could track this emotional battlefield, day after day. He used it to trade, and here's where it gets wild. Legend says he strung together 100 consecutive winning trades. 100. He made so much money that the emperor granted him the title of samurai. For over 2 centuries, this secret code stayed locked away in the Far East, like a hawk hiding its talons, as the old proverb goes. Now, let's jump to 1987. Picture a young American analyst named Steve Nison, sitting in an office with a Japanese broker. She's flipping through her charts and casually mentions, "Look, a window." Nison's confused. He knows what a gap is in Western charts, but a window? What's that about? Then she drops more mysterious terms. Doji, dark cloud cover. That moment, Nison was hooked. He realized there was this entire universe of market analysis that the West had completely missed. He became obsessed, spending years tracking down ancient Japanese texts, translating them, piecing together this lost knowledge. The book we're diving into today is the fruit of that obsession. This is the book that cracked open the vault and shared these Oriental secrets with the Western world for the very first time. Hard to believe, but before 1991, when this book hit the shelves, virtually nobody in America or Europe used candlestick charts. Now, they're everywhere. Every trading platform, every financial website, every market report on the evening news. This book is basically the Bible of candlestick charting. But here's what really matters. This isn't just some dry finance textbook. You don't need to be a trader to get value from this. This book teaches you how to decode human psychology in its rawest form. It's a visual language for witnessing the eternal tug-of-war between fear and greed, hope and despair, played out in real time. Here's my promise. By the time we're done, you'll never look at a financial chart the same way again. What looks like random squiggles and bars right now will transform into a vivid story. A story packed with conflict, standoffs, and sudden dramatic plot twists. So let's dive in and learn the ancient language of the candles. Before you can read any story, you need to learn the alphabet. The beautiful thing about Homa's system? The alphabet is wonderfully simple. For centuries in the West, we've relied on something called a bar chart. It's just a vertical line with a tiny tick on the left showing the opening price and another tick on the right for the closing price. It's functional. It gives you the data, sure. But here's the thing, as Steve Nison explains, Japanese candlestick charts give you the emotion. They take that same information, open, high, low, and close, and transform it into something that practically leaps off the screen. It's visual, it's dynamic. The prices literally jump off the page. So how do you build a single candle? Just 2 parts. First, there's what the Japanese call the real body. Nison describes this as the essence of the price movement. It's that rectangle in the middle, showing the battle between where the price opened and where it closed that day. The color tells the whole story. If the real body is white or green, common in today's charts, it means the closing price was higher than the opening. The buyers, the bulls, won that day's battle. Optimism ruled. If the real body is black or red, the closing price dropped below the opening. The sellers, the bears, claimed victory. Pessimism took over. That's it. A long white candle, strong buying day. A long black candle, heavy selling pressure. The second part consists of those thin lines poking out from the top and bottom. These are the shadows, sometimes called wicks. The shadows show the extremes of the battle. The top of the upper shadow marks the highest price reached all day. The bottom of the lower shadow shows the lowest point. Right there, in that one simple shape, you've got the complete story. Where the fight started, where it ended, who won, and the total range of combat. Now, here's where it gets really interesting. A single candle is like a letter. String them together, and you get words. Some of these words scream warnings about shifting market psychology. The first major signal? Indecision. Imagine a powerful rally, day after day of confident white candles marching upward. The buyers totally dominate. Then suddenly you spot something different, a candle with a tiny real body. Nison says the Japanese call this a spinning top. Doesn't matter if it's white or black. What matters is that miniature body. This little candle whispers that the previous momentum is running out of steam. It's the first hint of a possible reversal. Why? Because it shows a stalemate. Buyers and sellers slugged it out all day, but neither side could claim victory. The market is losing its breath, as the Japanese would say. Now, what happens when the real body shrinks so much it becomes just a horizontal line? When the opening and closing prices are identical. This is a doji. A doji is one of the most powerful signals in the entire system. It's a crystal clear flag of indecision. The market sits in perfect balance. The trend has frozen, become petrified, as Nison puts it. Spot a doji after a long rally? Consider it a warning. The buyers have exhausted themselves. Sellers are stepping up to match them. The battle's reached a deadlock, and the trend is vulnerable. So we've learned that long candles mean conviction, tiny candles signal indecision. But sometimes a single candle tells an entire reversal story all by itself. This brings us to a fascinating group called umbrella lines. Imagine a market that's been tumbling for weeks, black candles everywhere. Fear fills the air. Then a new day opens. Panic selling explodes. Prices crater, dropping hard and fast. Looks like another disaster in the making. But then, something shifts. Down at that new low, buyers spot a bargain. They rush in. The selling stops cold and buying takes over. Prices start climbing, and climbing, and climbing. By day's end, the market closes right back up near the opening, at the very top of the range. This candle is called a hammer. Perfect name, right? It's got a small real body up top and a long, lower shadow. That extended shadow is the scar from the morning's battle, but the close at the top proves the buyers won. The market is literally hammering out a base. It's a powerful bullish signal that the bottom might be in. Now check out the genius of this system. Take that exact same shape, small body at top, long lower shadow, and place it at the peak of a long rally. It's no longer a hammer, now it's a hanging man. Ominous name, deliberately so. It looks like a hanging man with dangling legs. It's a bearish warning. Think about the psychology. The market's riding high. Opens near the peak, then sells off hard during the day, creating that long lower shadow. The bulls managed to push it back up to close near the high, but that sell-off was a shock. It reveals that sellers are getting aggressive. There's a crack in the armor. Nison's really clear here. A hanging man isn't an immediate sell signal. It's a warning that needs bearish confirmation. If the next day opens lower or closes lower, then everyone who bought on that hanging man day is literally left hanging with a losing position. That's when panic can set in. This brings us to two candle patterns. Now we're moving from words to phrases. The heavyweight champion, the engulfing pattern. This is a major reversal signal. Picture a downtrend with a black candle, sellers still controlling things. But on day 2, the market opens, and buyers storm in with overwhelming force. The day closes as a strong, long, white candle, one whose real body completely swallows the previous day's black candle. This is a bullish engulfing pattern. It's a visual representation of a total psychological takeover. The optimism of day 2 has completely engulfed day 1's pessimism. The opposite? The bearish engulfing pattern. After a rally, a confident white candle gets completely engulfed by a massive black candle. This shows that supply has overwhelmed demand, and a top is probably in. Nison notes that if this happens on really heavy volume, the signal's even stronger. Not all reversals are that dramatic, though. Sometimes the shift is subtle. Enter the dark cloud cover, wonderful name for a bearish top reversal. Here's the story. Day 1 is a strong, long white candle. The rally's charging forward. Bulls are confident. Day 2 opens with a gap higher. The market opens above yesterday's high. Pure euphoria. Bulls are ecstatic. But then, sellers see their chance. That high price doesn't hold. Prices start falling and falling. By day's end, the candle's black, and it's closed deeply within the previous day's white body. Powerful bearish signal. The market's failure to hold that new high screams weakness. It's like the sun was shining, then a dark cloud suddenly rolled in, covering the morning's optimism. The bullish mirror image, the piercing pattern, happens at a bottom. Day 1, long, black, pessimistic candle. Day 2 gaps lower at the open. Total panic vibes. But then buyers step in. The sun pierces through the clouds. The market rallies all day, and the new white candle pushes more than halfway into the previous black candle's body. The bears' failure to keep the market down signals a powerful reversal. Now we can explore 3 candle patterns. These are like complete sentences, and they're some of the most reliable signals Nison shares. The rock stars, the morning star, and evening star. Let's look at the evening star. It's a top reversal that, as the name suggests, appears just before darkness sets in. Nison brilliantly describes this as a traffic light. First, the green light, a long white candle, the rally's strong, everyone's in full speed ahead mode. Second, the yellow light. This is the star. A star is a small real body, could be a spinning top or doji, that gaps away from the first candle. This is the stalemate, the market's warning signal, telling you the previous trend's power has faded. Third, the red light, a black candle that closes sharply into the first day's white candle. This confirms the top. The trend has stopped. The morning star is the exact opposite. It's a sunrise that signals higher prices ahead. It starts with darkness, a long, black, fearful candle. Then the morning star, the planet Mercury appearing before sunrise, a small star of indecision that gaps below the black candle. Finally, sunrise, a strong white candle that drives deeply into that first black candle, proving the bulls have seized control. These star patterns pack such a punch because they show you the complete 3-act reversal drama, the old trend, the indecision, and the new trend, all in one clear picture. Not all patterns signal reversals, though. Some are what Nison calls continuation patterns. They signal that the market's just catching its breath before continuing in the same direction. The most important? The window. A window is what we Westerners call a gap. It's a price vacuum. A rising window means today's lowest price is higher than yesterday's highest. The market was so bullish it literally leaped forward. Very strong bullish sign. The Japanese have a saying about windows. Corrections stop at the window. This means a rising window becomes a new support area. The market often pulls back to close the window, and that's precisely where fresh buyers wait to jump in. A falling window, naturally, implies lower prices ahead and becomes a resistance zone. Finally, Nison shows how all these words and phrases weave together into a complete narrative, often using military analogies common in Japanese feudal history. There's 3 black crows, a very bearish pattern of 3 long, declining black candles. Beautiful name. It's as if a group of crows sits ominously in a tall dead tree, looking down on the market. The opposite? 3 advancing white soldiers. Not a sharp, panicky rally, but a gradual, steady rise. Each of the 3 white candles opens within the previous day's body and closes at or near its high. This signals a healthy, strong, confident market. Each pattern has a name, a story, and clear psychological meaning. But here's Steve Nison's real secret, the one he emphasizes most. Don't rely on any single signal. The real power comes from what he calls convergence. This is the most important concept in the entire book. Convergence happens when different signals all cluster together, telling you the same story. For example, what if you spot a hammer, and that hammer also tests an old rising window, and it also forms a tweezer's bottom, where 2 candles share the exact same low? Now you don't just have one signal, you've got 3 different signals from the same ancient toolbox, all pointing to the identical conclusion. This, Nison teaches, is how you blend Eastern and Western techniques. Look for that cluster of candles. See if a Japanese hammer aligns perfectly with a Western support line. When the ancient secrets of the East and modern Western analysis converge, that's when you can have maximum confidence. You're not guessing anymore. You're reading the market's clear, emotional story. We've journeyed through the heart of Japanese candlestick charting techniques. What strikes me most profoundly about this book, its real lesson isn't actually about stocks or rice. The real lesson is about psychology. In our world of high-speed algorithms, artificial intelligence, and instant news, it's remarkable that a 300-year-old system invented by a Japanese rice trader to track human emotion remains one of our most powerful analytical tools. It's a timeless reminder that no matter how sophisticated our technology becomes, markets are still driven by 2 simple, primal forces: fear and greed. They always have been, and they always will be. What Munehisa Homa and Steve Nison have given us is a language to see those emotions. They've given us a way to read the room. The real skill this book teaches is a form of mindfulness. It trains you to pay attention to the present moment, the battle of this session, this candle. It teaches you to spot the shift in sentiment as it happens, often long before the crowd or computers catch on. You learn to recognize the spinning top of indecision, the dark cloud cover of sudden failure, or the hammer of resilient hope. So how can you start using this, even if you never plan to trade a single stock? Here are a few simple ways to begin. First, just observe. You don't need to risk any money. Next time you're curious about a company, open a free charting tool online and switch from line chart to candlestick chart. Just look at it. Can you see the story? Can you spot the long white soldier candles in a strong rally? Can you see the tiny doji where the market paused, full of indecision? Second, try finding just one pattern. Don't memorize all 50. Learn one. My favorite for beginners is the engulfing pattern. Just scan a chart and look for a day where the candle's body completely swallowed the day before. It's the most dramatic, visual, easy-to-spot signal of total psychological reversal. Third, think in emotions. When you see a long black candle, don't just think it went down. Think, that was a day of fear. When you see a hammer, don't just see a shape. Think, that was a day of resilience and hope. Start associating these visual patterns with the human feelings they represent. This is what Steve Nison's work is all about. It's not a magic crystal ball. It's a tool, a powerful one. It's a powerful synergy of Eastern and Western analysis that gives you an edge over those still staring at plain, lifeless bar charts. That's our journey through Japanese Candlestick Charting Techniques by Steve Nison. We've hit the major highlights today, but I'll be honest, a summary is just a map. Reading the book itself is the real journey. The true power isn't in memorizing patterns, it's in the hundreds of real-world charts and examples Nison provides. It's in those quiet aha moments when a specific chart suddenly clicks, and you see the traffic light of an evening star for yourself. If any of this sparked your curiosity, I genuinely recommend picking up a copy. It's not just a technical manual, it's a new language for seeing the world. And if you found value in this journey today, I'd be grateful if you'd subscribe and join our community. We're here to explore the great books that help us understand the world, our markets, and ourselves, one idea at a time. Let's keep growing together.